Hi, folks. Welcome to the Ask Weekend Investing round number 54. Before we move ahead, please do like and share this video and do subscribe to the channel. As you know, we have been answering all user questions every week. 830 queries have been raised so far, and more than 53 rounds. 53 rounds have been done till date. All these videos are available. So do go through them and get many of your questions answered through them. Let's take the new ones. Sumit says, in your experience, what is the most underrated psychological challenge of following a rule-based momentum strategy? Is it having to enter at high price points, exit performers just because others are performing relatively better? What are some of the other aspects that you can highlight? Good question, Sumit. The biggest challenge that most investors who will first time come from a discretionary environment into a non-discretionary and especially momentum rule based strategy is the difficulty of giving up control. So the first and foremost challenge that most people will find is that, I like this stock but the strategy is selling it, or I don't like this stock, the strategy is buying it. How should I deal with that? So the biggest challenge is that you have to remove the you from the equation. You are nowhere in the picture when it comes to the decision in this regard. That part is the most difficult, probably, for those who are very used to picking stocks on their own and sort of doing their own thing. So that control, just like when you sit in a car that you're used to driving and you allow somebody else to drive it, I mean, you are basically doing backseat driving, or basically you are unable to give up that control. That, okay, let him drive. I've chosen this situation. So that, I think, is the biggest psychological challenge. The second, of course, is the style of investing. So conventionally, people will buy low, sell high. Here we are buying high and selling higher. So it's very, very difficult. You are the mentally you are ingrained to buy things that are falling. Here it is absolute opposite. You have to buy things that are rising, and a lot of times that transition in your mind takes time. But once it does, you can never look back, actually. So these are some of the aspects, I think, which are most challenging. But the first one, the one to give up control, I think that remains the biggest challenge for people. And second, of course, is buying as stocks go up and selling as stocks come down. That is the second challenge, so as to say. Mahesh says, how does one distinguish between a core and satellite portfolio? Who is core portfolio for and what is satellite portfolio for? What are the characteristics of these two types, which are core and satellite? Okay, good question. So core portfolio, as it is called, is something that is going to be the bulk of your portfolio. So let's say if you have 100 rupees allocated towards equity, then perhaps 60, 70, 80% is core portfolio. And then you may try some on the side, some satellite, some, specialized strategy, or a alternate investment of some kind. Or some people may do 10% allocation to futures and options. Some people may do 10% allocation to some other mergers and acquisition kind of moves in the market. So that is sort of satellite, in the sense that that part is likely to be a higher risk, higher reward scenario, whereas your core portfolio is something that you don't want to take too much risk with. So that is sort of the core difference in that. In the weekend investing strategies, I would believe the all cap strategy and combinations of, let's say, MI Evergreen and MI20, or HNI Wealth Builder and HNI Capital Compounder. These are some of the core sort of strategies when taken together. And then some satellite strategies may be there which are focused on certain aspect, like the two all-time high strategies are focused on chasing all-time high stocks, or the Nifty Next 50 is concentrated strategy on Nifty Next 50 stocks, trying to get that alpha out of that. So those perhaps could be your satellite ones. But the core one should have abundant exposure to the entire market and potentially the gold hedge as well. Chandrasekhar says, I've been confused about diversification within equities. There's large, mid, small, micro. There's domestic, global diversification. What is your take on this matter? Is there a way for people to simplify? Good question. So I think the major distinction could be between large, mid, and small. Micro is not everybody's business because micro requires perhaps a lot of, I would say, higher risk taking ability. So if you stay within large, mid, and small, that probably is good enough. And instead of micro or global diversification, if you think, you could opt for a allocation to gold, and that should fulfill your suit of the diversification. If somebody really wants to, they can also add a US layer. uh, I wouldn't say global stocks because then it becomes a very wide canvas. US stocks is something that we naturally sort of want to diversify toward because there is fantastic growth happening in some of the companies there. So, so that's probably the maximum diversification you want to go. And there is nothing wrong if you have not gone the whole five layers. If you are, let's say, just in large and mid and you're doing well, I mean that's not bad as well. But as your portfolio becomes larger, as you probably want to diversify more and more, then these are some of the things that you may want to do. Ishit says, please clarify common misconception amongst gold investors. Okay. If one buys SGB from secondary market of, let's say, issue maturing in 2029, 4 years from today, and hold it till maturity, will then also be capital gains is exempted? Yes, it will be capital gains exempted. That is my reading of the law. Also, sometimes you buy SGB from secondary market just before interest payment date. So how do they settle accrued interest to seller? So if you are buying on the date where the SGB has moved from the seller's demat account to your demat account before the X dividend date or the X interest date, then you will get the interest. If on the date of the interest going X, if the SGB is lying in the accounts of the seller, then he will get the interest. So it is very simple. Just like dividends in stocks, there is a X dividend date. On the record date, whoever holds the stock gets the dividend, regardless of whether you have transacted or not. So that these two things are reasonably clear. Uh, Ali says, I am invested in MI Evergreen. Now that MI All Cap Gold is also launched, can we consider keeping different rebalance dates as there may be slippages due to overlap in both strategies? Um, Not really, because MI Evergreen is focused mostly on large caps, and All Cap Gold is large cap plus mid cap plus small cap. So I don't see any concern there. Um, so you don't need to do that. Priya Raj says, planning to invest in new investment strategy, specialized investment fund. I'm a businessman and I don't have much time to study and buy direct stocks. And my business income is irregular, so mutual fund SIP is not an option. PMS ticket size too large, so SIF looks good option for me to park one part of my savings in this scheme. Is it safe to invest in this category as there is no track record? Your view on this investment strategy? I think you have answered yourself very well. There is no track record right now. So why do you wish to rush into this? Let there be a track record of some sort, and then consider the specialized investment fund. I would think, I mean, unless you have good confidence on the particular manager that you are looking at, because these are untested, untried mechanisms, including FNO in that space. So I'm not sure if it is wise to immediately jump in, but I could be wrong. Rakesh says, you have mentioned that if everyone starts following momentum, will it stop working? Do you think that the discomfort it creates ensures it always works for the discipline? I'm not sure what discomfort you're talking about. We need to get comfortable with it, first of all. If you are disciplined, you will feel very comfortable. If you are not disciplined, you will feel discomfort. So this idea that momentum investing is discomfort or does not give you comfort, I think is exactly opposite of what I feel. At least for me, I feel extremely assured, extremely comfortable knowing that I will get out of weak stocks sooner or later and I will get into strong stocks sooner or later. And the history tells me that I'll do reasonably all right in beating inflation. So discomfort should be thrown out of the window in my view. Secondly, this question about everyone starting to follow momentum. Well, if everybody, becomes vegetarian, then the world will be full of poultry. I mean, the streets will be full of chicken. So nothing is binary. There's no zero or one only. There is always a balance that happens on their own. Momentum investing is such a strategy which is psychologically difficult for conventional investors to follow. It requires extreme, and when I say extreme, it is not easy. You have to retune your mind that I'm going to buy stocks that are going up. That retuning does not happen for most people. So to think that everybody will start following momentum, I don't think so. No chance. Just like the other way, it doesn't work. Everybody doesn't do the value or whatever. So Deepak says, at what stage is a review of strategy parameters called for? Should it be only basis of performance? And if so, what should be the period of consideration? Yes, so over a business cycle of whatever 5 to 7 years that we see, if you find that some strategies stop working, some strategies not working anymore, maybe there's a change in the way the markets are behaving. Like for instance, I can tell you in the last 5 years, the market behavior is changing that it doesn't go into deep drawdowns. So that impacts a certain kind of strategy. Um, Whether that will stay that way or not, or will come back, also can make a difference. So no clean answers for this, but it's just like I'm driving my car. So at what stage of fuel efficiency will I say that okay, this is getting old, let me get a new one? It's a gray zone. Of course the performance may degrade over time, but then there may be so many other considerations. But yeah, I mean, this is a good question. At least one full business cycle from peak to peak or trough to trough should be seen for every strategy. Dr. Gandhi says, Namaste Alokji, if a retail investor is investing in mutual funds via SIP and in stocks, how much alpha on mutual funds should be generated in at least in order to justify actively investing in stocks? Answer is, sir, very simple. Determine how much time you are spending in doing your direct investing in stocks. And I'm not just saying the transaction. If you are watching the markets every 15 minutes, that time is also to be attributed to that activity. How much sleep are you losing because you have invested in direct stocks? How much more worried are you? How much more your BP is going up? All those factors combined, if you can come to a justification that at least 5%, at least 10% more than what I can get without thinking about it, then probably it's worth it. On average, I mean, if you were to ask me, unless it generates, let's say, minimum of 5 to 7% more than a average fund would, I would not go there. That would, I mean, I would think I would value my time more than that. And especially you are a doctor, you can really mint money every minute. So from that point of view, I'm not sure. Another question from Ali: several active mutual funds are also being launched in the momentum factor. Do you feel they will face any challenge in effectively executing the strategies versus weaknesses due to size? Yes, I mean, size will remain a challenge for any large fund in this space. The most liquid counters also cannot sustain frequent buys and sells. I mean, go see any mutual fund. They're 50,000 crores, 1 lakh crores. Let's say there's a momentum fund of 50,000 crores. Okay. Let's say they invest in 20 stocks. So the average hold is 2,500 crores, right? Now 2,500 crores of buying or selling will be needed every time they want to switch. So let's say they are 2 to 5% of the weekly volume of a stock. So if they need to move 2,500 crores in one stock, that stock should at least do 50,000 crores of volume every week for them to easily buy in and get out if it's not a fund to fund deal. So when you talk about 50,000 crores per week, your universe will shrink to 100 stocks. So distributed assets in many strategies with small funds can work. Concentrated funds in that space may find it challenging. You're right. That's the end of the Ask Weekend Investing round. Thank you so much for asking these queries. I hope I've been able to answer some. And if not, send me a mail and I'll try to take it up again. If I miss some query, please do send us mail. We'll try to take it up in the next episode. Thank you so much and keep watching these. All the previous episodes are here in case you wish to go through them. is a huge question bank that is already available. So instead of watching your favorite serial, perhaps this weekend, maybe you can do a back-to-back 50 episodes here. Thank you so much for watching. Do like and share these videos. Do subscribe to the channel. Thanks. Bye.